All right. Matt the Mortgage Guy. In today's video, I want to go through this article. A great client of ours sent this over. Angela, you know who you are. Thanks for sending this. Send these articles if you'd like me to just kind of reply to them or give my 2 cents on what they're saying. Tons of stuff out there. Is the market going to crash? Are we in a bubble? Are home prices overpriced? What's going to happen with mortgage rates increasing? All this type of stuff, right? This is a good article, well written, talking about homes being overvalued. I'm going to go through it in detail, tell you what I think about the article coming. All right, Matt the Mortgage Guy here. Really interesting article about the housing market. And trust me, there is no shortage of articles about the housing market, videos about the housing market. Everybody seems to be talking about the housing market. What's going on in 2022? A lot of sensational headlines. And then when you dig into the article, you realize, okay, after all is said and done, this article agrees with me. The market's going to flatten out, right? And it's going to feel a lot different than a market that was seeing 15 or 20% home appreciation. I don't want to spoil it for you here, but kind of come to that conclusion after all the stuff in this article that while it feels overvalued in a lot of areas across the country, the fact is there's enough demand and not enough supply to where a serious home price correction is very, very unlikely and probably off the table. A flattening, or at very worst, a 5 to 10%, depreciation, price correction in the cards for 2022. So, title of the article obviously wants to get you to click. Housing market resembles 2007. That'll scare the shit out of anybody. And it's got some pretty cool interactives, right? And I will link this article below so you can look at it for yourself about which markets are overvalued, which ones are undervalued. And for this article, they use really good resources like CoreLogic and Black Knight to gather this data. So the data is good, right? And I'll tell you how they arrived at the data and why you might want to be a little bit weary of some of it, right? So essentially, they're talking about home prices being up 19.8%. Private sector wages are only up 4.8%. So, obviously, if wages aren't keeping up with home price appreciation, things are becoming less affordable. The number they use is that 32% of somebody's income is going to have to be used for their housing payment. Some other periods in history, that might be as low as 20%. Quick math, if you're making $10,000 a month combined in your household, and the housing payment is 20%, that's $2,000 a month. If it's 32%, that's $3,200 a month. It's quite a big difference, right? Obviously, you'd prefer to have a $2,000 a month payment when you're making $10,000 versus $3,200, right? More discretionary spending. Another thing that wasn't in this article but comes to mind as we talk about this, everything else is more expensive, right? So besides housing being expensive, and I'm going to talk about housing as a purchaser of real estate and also as a renter, right? Let's not fool ourselves. Rents have gone bananas over the last few years. So a $2,000 rent might have increased to $2,800 over the last 36 months. So that is real as well. But besides that rent or mortgage being a larger percentage of your total income, gas and transportation is more expensive. Food is more expensive. Everything is more expensive, right? Inflation is real. It sure ain't transitory. So they go across the nation with this research, and it's Moody's Analytics, CoreLogic, and Florida Atlantic University has like a real estate initiative, a team that's working on these assessments to tell you whether your market is overvalued, undervalued, or normal, right? This one's interesting, right? And here's CoreLogic's I can hover over this and it'll tell me what the specific market is. Red means overvalued. Purple means normal. And then if you can find some blue ones in here, that's undervalued. You want to know what's interesting for me being in Northern California? Santa Clara, median home price is definitely over $1 million, undervalued. San Francisco, Oakland, Berkeley, another one, the median price is over $1 million, undervalued. And this overvalued, undervalued is a function of what the median income in that area can afford. So the only explanation for a neighborhood or a county that is expensive as F to be undervalued is that, you know, the income must be $500,000 a year in Silicon Valley and some of these tech hubs, right? For the $1.3 million median home price or whatever the wild number is to be considered undervalued, right? Because then you go to a place like Sacramento where our median home price is 40% of what it is in the Bay Area. It's a guess, by the way. It's not the true stat. We're overvalued, right? Versus the Bay Area, which is undervalued. So, you know, they did an assessment of like over 400 markets. 65% of them, you can see a lot of red here, right? Overvalued. 26% of them are normal, which is the purple. And then you can hardly find any blue, which are undervalued. Oh, there's Detroit, Dearborn, Michigan, Flint, Michigan, Bay City, Michigan. What else we got? Some Illinois. We got some Missouri. What else we got? Some Kansas. Anyhow, only 9% are considered undervalued based on, you know, the sales data from February. That's what CoreLogic used. And obviously, they reference here that the 30-year fixed mortgage rate has gone from 3.92 to 5.3 since February. So all indicators are that home prices are higher and rates are higher. So this is probably even more skewed towards red, quote unquote, overvalued than when they did this back in February. This is that Florida Atlantic University, similar type study that, you know, lumps it into like different brackets, whether it's 0 to 15% overvalued, 15 to 30, or 30+% overvalued. There's a lot of 30 plus. Riverside, 30.76. Las Vegas, 59. This is Boise, 75% overvalued. I mean, these are some wild numbers. I don't want to skip over up here because CoreLogic, you know, talked about all these markets being overvalued, but says only 3% of regional markets have a high or elevated chance of seeing a home price decline over the coming year. So 97% of these markets they consider, you know, overvalued, likely not to see a home price decline. So it's like, hey, these are overvalued, but prices aren't coming down, right? The risk of price declines remains low in their latest market report, you know, so take that for what you will. The Florida Atlantic survey for March, remember CoreLogic's February, 100% of America's largest housing markets are overpriced relative to what economic fundamentals in those markets were support. So, you know, based on the income in those markets, 100% of them are overpriced by their metrics, right? And then you got Moody's Analytics, and they did something similar with a different type of scale where it goes from yellow and then it gets darker and purple as it gets more overvalued. Boise City, 73, Vegas, 46. I wonder what month they did this. 96% of them are overvalued according to Moody's. And similar to what CoreLogic said, Zandy from from Moody's, he's the chief economist over at Moody's Analytics, Mark Zandi, tells Fortune he thinks U.S. home prices will be flat. The economic shock caused by spiking mortgage rates should be enough to cool off the historically hot housing market. However, the most overvalued regional housing markets could see home price dips of around 5 to 10%. So with all this being said, I would agree with the sentiment by CoreLogic and by Moody's Analytics that, affordability is, a lot worse than it was last year, worse than it was the year before. According to metrics, income versus the home prices and income versus the mortgage payments, overvalued, all these things are true. But based on the supply versus demand imbalance, based on the things that drive home prices, we are very unlikely to see home prices decrease. As a buyer, take that for what it is, right? Don't expect to get something on sale next month, the month after, next quarter, the quarter after. I just don't think it's going to happen. Will it get easier? Will things flatten out? I think so. I hope so. I think that the next 2 quarters are going to be great quarters to be a home buyer. More choice, a little bit more leverage, keep your contingencies in place. Don't have to compete with 17 offers, only compete with 1 or 2. I like it, right? But do I think you're going to get a 20% discount or 30% discount next quarter? No, I really don't. These folks tend to agree, right? That flat to a 5 to 10% decrease, almost nobody thinks that we'll see those decreases anytime soon. Like most analysts are between 5 and 10% home price appreciation for 2022. So anyhow, my 2 cents. Thanks again for sharing, Angela. I appreciate it. Any comments, concerns, agree, disagree, feel free to leave your comments below. It's a free country, so you're free to say what you want, right? All right, until next time, we gonna see.